All rise. Court of Appeals, Division 1 is now in session.
Good morning. Please be seated. This is the time set for oral argument in the case of Penn Racket Sports, Inc. versus Maricopa County and the Arizona Department of Revenue. Our tax number 13-0001. Each side will have 20 minutes within which to make their arguments this morning. Appellant may reserve some portion of that time for rebuttal. That's entirely up to you. We have read the briefs. We've reviewed the record. We have conferenced the case, so we're familiar with the underlying facts and the issues that have been raised here, so please keep that in mind as you make your arguments this morning. We are recording the proceedings, not in terms of an official record, but for our own use, certainly as an audio file. There's also, the arguments are being digitally recorded with video, and that video will be available eventually on our website. So if you're interested, you can go look for that later on. With that, Counsel for Appellant, may proceed.
May it please the court, my name is Dan Garrett. I represent the appellant in this matter, Penn. And the case that we have before us is a refund claim based on an error where both the Department of Revenue and Maricopa County made an error in not following specifically provided statutory provisions. And in 4213-352C.
So, Mr. Garrett, the error that the assessor made was in deciding to follow the personal property manual that the department provided.
It would be Maricopa County did not follow statute and instead followed an erroneous manual.
They could have exercised their discretion to not follow that manual.
I believe so. I believe that they have the I believe that they are required to follow statute. And just as a manual is like an administrative code provision or regulation that is subordinate to statute, and you first follow the statute. And I mean, they could have argued, but they didn't know about it. They missed it. Had they known about it, I think they would have done it right. But they didn't know about it. The Department of Revenue didn't know about it. I don't know when the mistakes were made, but basically what they did is they put in an adjustment that isn't provided for in statute. It's supposed to be acquisition cost less appropriate depreciation as prescribed by the department. The department prescribed straight line depreciation and then made another adjustment, a trending adjustment, which has nothing to do with depreciation. A depreciation adjustment is for adjustment down in the value for normal wear and tear over the life of an asset. That's depreciation.
And it isn't, maybe I misunderstood what the department's position is, but the depreciation method, formula, however you want to characterize it, that they chose was based upon the fact that the cost number at the top of that calculation was an adjusted one, not just an acquisition cost.
They say that, but there's no real way for them to make an adjustment to make that happen. They mention that, but you can't...
Changing their manual.
No, not even if they change their manual. They can't fix it the way they would want to do it. What they want to do is to be able to adjust acquisition cost, increase acquisition cost, and then depreciate it.
But
you can't.
Didn't Ms. Gray in her affidavit describe in detail the steps that the department would take to recalculate or adjust its depreciation formula if, in fact, the starting point for valuation was acquisition cost alone?
Her approach was erroneous. And the reason why it was erroneous is because to adjust depreciation, following the statute, you have to have acquisition cost less appropriate depreciation. They can't adjust acquisition cost, so they'd have to adjust appropriate depreciation. Going forward, if they want to make changes to their manual, they can. But what they did is they provided an approach, and if they want to use a different approach, all they're going to be able to adjust, under their current approach, they adjust it every year.
Doesn't your argument assume that there is only one means of scheduling out what appropriate depreciation is? And you're asking us to say it started with replacement cost new rather than acquisition cost. That's an error.
Mm-hmm.
Fix the error, go back to acquisition cost, and then apply the same rate of depreciation. So that assumes there's only one appropriate rate, correct?
Well, I don't know what the appropriate rate is. What we know is what they prescribed. They prescribed to use straight line depreciation with a certain number of years. If they wanted to stretch the years out some, they could stretch the years out some. But why would they be doing it? If they're doing appropriate depreciation, this is fundamental. If they're using appropriate depreciation, it cannot take into account ever increase in value based on due to inflation. That's not what depreciation is.
But
And the statute says depreciation. Yes, Your Honor.
Isn't there another part of depreciation which is the salvage value? And is it possible that the starting point, acquisition cost versus replacement cost new, might be related in some way, shape, or form to the salvage value?
No, it really isn't. Salvage value is a separate issue completely from replacement cost new. Replacement cost new is all about taking into account increases in inflation, in pricing. That's what it's about. And if you follow the statute, you can't get depreciation to include appreciation. In the manual, they said there's appreciation and depreciation because we've got true depreciation, and then we have the appreciation. Well, how can you fold in appreciation into depreciation? You can't do it. It doesn't work what they want to do. What they want to do is violate the statute. They want to eliminate the first sentence that says you follow the statute, and they want to go to the second sentence that says if the statute doesn't provide, then you use standard appraisal methods and techniques, which replacement cost new is. But you can never get the what you want or the results of replacement cost new cannot ever be incorporated into depreciation. You can't put the attic in the basement. You can't do it. And they're under the belief that you can. Well, you can't. Depreciation is only a value that decreases the acquisition cost for normal wear and tear over the life of the asset. That's what it is. If they wanted to adjust life of the asset, does that really have anything to do with inflation? No. And so they did appropriate depreciation. They did it. Now, if they want to try and they wouldn't be doing depreciation. They'd be doing some kind of other adjustment. And they've defined depreciation.
Oriented.
Yeah, it would be a result-oriented, which the tax court kind of let them do.
But don't you think that there might be another, well, don't you think that, isn't it possible that the appropriate depreciation scheme would result on what would relate to whether, to the starting point, whether you start with acquisition cost or whether you start with replacement cost new? I mean, isn't that the argument that the government is making, is that we have chosen a depreciation scheme that depends on where we start? And if we have to start at a different spot, then we would need to adjust our depreciation scheme.
They would do something different. But in doing something different, if they wanted to incorporate, and they said, we'd end up the same place. Well, you don't. You can't put in depreciation appreciation. Now, what are you going to do? Change the life you're going to say, oh, well, no, it really lasts longer. Well, what they did is they did appreciation. They didn't change the life. They said that it's the same life, but it's really just worth more because of inflation. So really what they're not arguing for is an extended life. Then they could say, well, it's not an extended life that we're after. We want to use something other than straight line. Well, if you use other than straight line, what are the things that you can use? Makers, other things like that. They're accelerated depreciation. They'd give the taxpayer even more. They want to use what is never used. An inverse, instead of accelerated, a deaccelerated depreciation. That's the only way that they could increase it. It's to say in the first year we're going to give you 10%. The next year, usually with makers or any accelerated depreciation, you get like 50% the first year, 40, 30 on down. The only way that they could do something effective is to flip it on its head and do something that no one ever does, ever, in depreciation, which is first year you get 10%, second year you get 20%, third year you get 40%. It doesn't make sense. That's not how economics work, and that's not how items waste away in value.
Counsel, is there a statutory definition of acquisition costs?
Yes, there is. Acquisition cost. It includes freight, sales tax, installation costs. It does not.
Statute has that?
Excuse me?
You call which statute has that?
I
I see it in the manual.
I do quote it. I'd have to dig through to find it, but in the briefs I do reference the definition. And what I say is, with that definition, it does not include trending. Trending is not included in the definition of acquisition cost.
Now the department seems to have interpreted it to include trending, right?
No, I don't believe the department has ever said that acquisition cost includes trending. What the department has said is that we can use standard appraisal techniques. We don't have to follow the statute.
Under the second sentence.
Right. We don't have to follow the statute. That's one thing that they said. And then the second thing that they said is, well, the trending is really included in the depreciation. It's not. It can't be included by definition, by their own manual and explaining how it works. And under replacement cost new less depreciation, replacement cost is a starting point. The Arizona Supreme Court, in one of the cases cited, understood how replacement cost new. It is standard in appraisal techniques is you take your acquisition cost, you take a trending factor, which is an inflation adjustment factor to increase the cost up, you increase the cost up, and then you apply depreciation. And so your starting point is replacement cost new. They try and back into it and say, well, really, we're allowed to make whatever adjustments we want. Well, the law doesn't allow that. There's limitations, especially on tax collectors. You can't just do whatever you want. Any adjustment is not allowed. The statute is clear. It is crystal clear. Acquisition cost, less appropriate depreciation as prescribed by the department. Now they want to prescribe something different. They already prescribed it. And if you look at what they prescribed, they can't do what they want through adjusting the depreciation without turning depreciation into non-depreciation and just some amalgamation of adjustments. And so if you look at the definitions of 42, 11,001 and 6, full cash value for property tax purposes means the value determined as prescribed by statute. And then we have two statutory provisions that expressly provide what it's supposed to be. And they ignored it. And why did they ignore it? Well, I mean, it wouldn't be mere speculation, but for property tax purposes, which is the vast majority of what they do, for property tax purposes, they're going to be using replacement cost new. That's just what they use. So they're used to it. Well, used to it is not a sufficient reason for violating statute. They're required to follow the statute. And they didn't. All the cases that they cite, support the taxpayer's position. Salt River Project case was an example where the department was doing the same thing. They were trying to inject notions of fair market value in a statutorily prescribed formula. And the court said, no, you can't do it. And this court likewise should say, I'm sorry, no, you can't do it. That which you want to accomplish, you can't do unless you go get the statute changed. And the shopping center statutes are done that way. The legislature knows how to do replacement cost new less depreciation. They've prescribed it in the shopping center statutes. And the court case that they cite regarding shopping center statutes supports what we're doing. Our position, which is that the statutes in question do set a statutory formula for valuation and that it needs to be followed. In the shopping centers, it showed that if you stop there, it would be prescribing a statutory formula. But they didn't stop there in the business realty case. But for us, it stops there, which means that's what it is. And it's clear. And taxation is supposed to be stated with specificity. Taxpayers are supposed to know. Now, they also say, oh, well, the taxpayer should have known. Taxpayer should have known. Taxpayer files to the government the acquisition cost. The government computes everything. And then the government didn't even compute it, replacement cost new, the normal way that you would do it, but they buried it and blended it. So you'd see just a factor. You don't know, and they did accurately call it a valuation factor instead of a depreciation factor because it's not a depreciation factor. Why? Because it's been tainted. It's been tainted with an error. And the error simply is they included a factor for trending, a trending factor. They should not have included a trending factor. Absent that, they did everything right. Now they say, oh, gee, well, the taxpayer is going to get a windfall. Wrong. There's no windfall. There is no windfall. What happened is they have received a windfall by not following the statute. There's nothing that they would do to the depreciation, nothing that they would do to the depreciation to be able to equalize it with what they want. You can't do it. They need to go to the legislature and say, okay, we want to do replacement cost new for this, just like we do for shopping centers. And if they don't do that, the law's not on their side. And we've got to have some respect for what things mean. And in their briefs, they really kind of go after depreciation and try and make it something that it really isn't. We need to respect what that is. And even in their own manual, they give a definition that we should follow. And in following that definition, they can't get there. Under the error correction statutes, objectively verifiable, have we got that? Sure. We've got a number. They've told us that they use straight line depreciation. We know what it is. We can compute it to the penny and adjust out the erroneous factor, the trending factor they put in. It's easy to do. It's an error that can be corrected. They want to try and say, oh no, the error isn't that. And the tax court made a mistake on this as well. And the error is really the valuation adjustment. And what I would say is no, there isn't. And the reason why is they can't get there under the law. They can't get there under the law. And so what is the appropriate amount?
Your argument is they simply don't have the discretion to adjust the front end part of the valuation formula.
In Nevada and Utah, they have similar stuff, except in Nevada and Utah, in the statutes, it provides for them to do it. If the statutes provided for replacement cost new in any vehicle or way or allowed trending or whatever, we wouldn't be here today.
Your argument is that acquisition cost, the starting point in the statute, can only mean
what it's defined under the statutes to be, and trending clearly isn't. And they know it. They know that trending is not a part of that because what do they argue? They argue that we should be using standard, standard business appraisal techniques, standard appraisal techniques. Well, replacement cost new is a standard appraisal technique, but it's not a statutory allowed item in this case. I'd like to reserve the 2 minutes that I have left, if I may.
All right.
Thank you.
Mr. Freeze.
Judge, may it please the court, my name is Jerry Freeze. I'm appearing on behalf of the Department of Revenue. I'd like to save 4 or 5 minutes for my colleague from the county, Ms. Patterson. There are two main issues in today's appeal. The first issue is Penn's claim the type of claim that's entitled to relief under the error correction statutes? And two, if it is Penn entitled to the relief that it seeks? Did the department commit an objectively verifiable error when it valued the property in the manner that it did? Now, on the first issue, the court held, as we all know, the tax court held that Penn's claim is not remediable under the error correction statutes, and it's fairly obvious, I think, why. It's because the error correction statutes, as they plainly say, have to do with an objectively verifiable error. It is a matter of fact. And not only must the error be objectively verifiable, but the relief must be objectively verifiable, because once the error is identified under the error correction statutes, a refund is paid. The error is objective, the relief is objective, and the refund is paid, and that's what the statutes provide for.
Well, Mr. Garrett just gave us a very impassioned presentation on his view that that there's a clear error here in the department's or the assessor's use of the department's manual, which directs some calculation of cost that is not acquisition cost.
Right. Well, passion doesn't equal logic, and passion doesn't equal the equivalency to proper statutory interpretation.
Well, how is it that acquisition cost means something other than acquisition cost?
Well, it means what it is. All it is a starting point. And then once you begin at the starting point, then you apply appropriate depreciation methods. And the appropriate depreciation method, not only in this state, but around the country, and in fact around the world, is what we employed. It's interesting that he mentioned the Utah statute, because the Utah statute, as he cited to the court, as he argued to the court in his briefing, he said, well, Utah begins with acquisition costs and Nevada begins with replacement costs. If the Arizona statute read the way the Nevada statute reads, then you would be correct in doing what you did. But it reads acquisition costs. Well, in Utah, as we know from the record, in Utah, they do exactly what the Department of Revenue does. In Utah, the Utah Tax Commission said in their manual, each year depreciation is trended to an estimate of replacement costs new using the Marshall and Swift Cost Index. This index adjusts for both inflationary and deflationary influences. That's what Utah does, even though they have the word adjustment or acquisition costs in their statute.
Okay, but that's Utah. I mean.
Well, that's the world, Your
but-
Honor.
Well, but I guess I'm concerned about the word of the statute.
Well, that's a starting point. If the legislature wanted to prescribe a particular depreciation method, they would have done it. They would have said a 5-year straight line or a 10-year straight line or whatever it might be. But what they said is they directed the Department of Revenue, you Department of Revenue, go out and do what you believe is appropriate in this situation using adjustment or the acquisition cost as a starting point. And that's what we did, and that's what Utah does, and that's what the world does. And I say that, sorry, Your Honor.
Does the department, does the manual direct use of a different table of depreciation depending on whether the starting point is actual acquisition cost or replacement cost new?
You know, it would actually be, if the legislature had denominated replacement costs, it would really be the same formula, because they really say the same thing, and that's what the Utah statute and the Nevada statute demonstrate. Whether you denominate or whether you legislate replacement costs or say the starting point shall be acquisition costs, it's the same analysis, and that's what the states demonstrate.
Well, no, my question was, as I understand application of depreciation,
Correct.
you figure out a salvage value, you figure out, and you might not do this in this order, you figure out a useful life, you figure out a salvage value, and you figure out whether you're going to apply a straight line formula or something other than that. Would that portion, under the manual, does that portion of the analysis change depending on whether the starting point is simply acquisition cost or replacement cost?
Yeah, I'm sorry, it would, because the depreciation schedule will change, because there is an objective. The objective is determining a percent good as of evaluation date. And if the percent good as of evaluation date is 58%, then the objective of the method is to get to that 58% number. And if you have a different starting point, presumably, if you use acquisition costs and do what the department does, and you do trending and then you do an adjustment, there would be a different depreciation schedule than if you just did replacement, or if you just did, replacement costs new. It would be different. Because again, there's an ultimate goal. The goal is to figure out the market value of a piece of property on a particular date. So as a case with real property, you value real property using the market approach or the income approach or the sales comparison approach. There would be different data. Personal property is different because you have a starting point. You typically do have a starting point. Property is of different ages, and you have to adjust for both inflationary and deflationary changes in the marketplace. If you take away the inflationary aspect of the adjustment of the valuation method, then you would adjust the deflationary aspect of it.
So the notion is by doing what the manual prescribes, the department's view is that you are more accurately arriving at what the value of the property is in any particular year.
We think the legislature charged the department with coming up with.
Is that right?
That's correct.
So, but under what, and that's admirable. Let's say that's admirable. But does the first sentence of the statute allow you to do that?
Well, I think it does, because all it is a starting point. If the legislature wanted to prescribe something, they would have done it. And they've done it in other statutes. They did it in the telecommunications statute. They did it in the airline statute. What they said in this case is, department, you go out in the world and you figure out what is the best, most appropriate way to depreciate personal property, items of personal property, to figure out a percent good. That's exactly what the Utah statute does. When I keep saying that's what the world does, we cited multiple times in our briefing the International Association of Assessing Officers. That's what they prescribe. So it's not just prescribed in this country. That's what you do around the world in valuing personal property, beginning with acquisition cost. And again, if the legislature intended to limit that, they would have done it. They would have said, do the following, use straight line or don't make an adjustment or whatever it might be. But what they said is, you do what you think is appropriate given this situation, using acquisition costs as a starting point. And that's what we did. And that's what all known authorities, to our knowledge, do. In the later statute, after the statute at issue, as we pointed out in our briefing, the legislature did prescribe a statutory depreciation number. They said, whatever value you, department, come up with in the valuation statute, we want you to depreciate that value an additional 30%. Now, is that a market approach? No, that's not a market approach. That is a diktat. That is a legislative approach. They could do that, again, as they've done it for telecommunications companies and the like. But in this case, they said, department, come up with a method. And going back to the error correction statute, an appropriate valuation method. So we go back to the error correction statute, and if the court were to hold, well, this is not appropriate, what they do around the country and around the world is not appropriate, then it would be kicked back to the department. There is no objective relief available. Straight line depreciation is not a valuation method. There's no doubt about that. There's no authority from the appellant about straight line depreciation being a valuation method. It isn't. It's an accounting method. It's an allocation method. So what would happen is it would have to be kicked back to the department, and the department would then come up with another valuation method, looking at different data, whatever it might be, to come up with a value and to determine a percent good. And it's not result driven. It is what it is. It's what the market suggests it is. But what the department has determined is the way that Utah does it and the way that all the known authorities on the issue talk about it, the best, most efficient way to do it to yield the best number of percent good for personal property is the method that the department used. But again, getting back to the error correction statute, if it were to be kicked back to the department, sending it back to the department to have the department figure out appropriate depreciation is not the subject of an error correction. You can't do that. It's like saying, I'm not happy with the value of my office building. Let's send it back to the assessor and have the assessor come up with a different value. Well, that's a valuation appeal, and there are deadlines for valuation appeals. And the deadline for the valuation appeal is December 15th of the year before the tax year. You have an obligation before the tax year even exists to challenge the value. The error correction statutes, on the other hand, contemplate and permit going back 3 years. You get 3 years of error relief and 3 years of refunds. Why? Is because it's objective. There is no doubt that the government erred when it valued the property in the manner that it did. And so what the legislature said, I think rightfully, is if there's no doubt, if the government collected taxes to which it is not entitled, they should have to pay that money back. But again, that's an objective error. And this is not an objective error. We clearly think the court was right in that regard.
Mr. Freeze, going back to the manual for a minute, is that adopted by a regulation? It's not. I mean, it's not referenced in the statute.
Correct. I don't know, Your Honor. It's been around for decades. I don't know how they adopted, how they amended. I really don't know.
You don't know whether it was done in a rulemaking?
I don't know. No, I'm sorry. So in addition to the error being objectively verifiable, the relief must be objectively verifiable. But more importantly, it must be correct. And the relief being sought by the appellant in this case is straight line depreciation. Well, straight line depreciation, again, is not correct. So, again, they fail in that regard.
And it's not correct because it, in your view, it doesn't properly account for the fact that it doesn't properly reflect the value of the property.
Correct. Well, to begin with, it's not a valuation method. It's an allocation method. It's what you do for tax purposes. It's a matter of allocating values and taxes and whatever it might be in tax returns and the like, depreciation schedules for accountants. This is concerned
Well, the
with value.
statute does refer to depreciation, so
Well,
we have to acknowledge it.
Correct. But there are different types of depreciation, and all the authorities cited to the court. And if there was an authority out there, I assume Penn would have found it cited to the court about straight line depreciation being an appropriate depreciation method for valuation purposes. It is not. In fact, all the authorities say it isn't. So the fact that it's depreciation doesn't make it appropriate. In fact, it is wholly inappropriate. So again, not only must the error be objective, but the relief must be objective and it must be correct. And it is wholly incorrect. I understand they want straight line depreciation. I'm sorry, Your Honor.
Does the department begin with, let me back, other than when the statute specifically directs the department to use acquisition cost as opposed to replacement cost new, does the manual, do all the manuals require assessors to begin with replacement cost new in valuing any kind of non-real property? Every kind of non-real property?
Well, I think I think it really depends. I think not. I think when you say non-real property, I think personal property. And so you turn to the personal property statutes and they say what they say. They say you begin with acquisition costs and then you then you depreciate it. And I think the department has taken the obligation by statute or whatever to figure out what the appropriate depreciation is, and the county follows it.
You know, I think my question was not very coherent. What I mean to say is, does the manual require use of replacement cost new across the board in every circumstance except where the statute specifically says otherwise?
No, not to my knowledge. What it says is take the acquisition costs of an item of personal property and depreciate in the manner you believe appropriate. That's what it says. So start with the acquisition cost and then depreciate it. That's what it says. So I don't know that it says.
There are circumstances in valuing property where the manual allows the assessor to start with strict acquisition cost as opposed to replacement cost new.
Acquisition cost typically is not a standard method for real property. You typically don't
Right.
look at
That's why I asked about non-real property.
Right, I understand that. Acquisition cost is typical in the personal property field. Legislatures use the word acquisition cost and replacement cost new, I think, interchangeably. That's, again, with the Utah statute and the Nevada statute. I think the statute in this case, all the statutes that we know about talk about acquisition costs and then applying appropriate depreciation.
You know, what I meant to say is, what I meant to get at, though, is whether in the department's practice and in the manuals, relevant manuals, are there circumstances in which the department acknowledges that replacement cost new is not the proper means of determining value?
Well, for personal property, yes. We talked about two situations. There are 6 different depreciation tables in the manual, I believe, and 2 of them rely upon the market approach, sales comparison approach, because they've determined that in cases of CPUs, personal computers, which depreciate relatively quickly and drop in value and are obsolete relatively quickly, that the market approach is the best way to go. And then in the case of equipment used to manufacture, I think, chip manufacturing technology, the industry was able to demonstrate to the department that there is a viable market for it, not just a liquidation market, but a viable market where people come and buy that property. So the department departed from the acquisition costs, the normal method that they do, and they did do a market or a sales comparison approach. So really, it's driven by the facts. It depends what is the best appropriate method to arrive at a percent good. So it is not just replacement cost new, they do deviate. And they're allowed to deviate. The legislature said, do what you think is appropriate. And there are 3 standard methods and techniques, and theoretically you could use the income approach, although the income approach would probably never be applicable to personal property because you don't generate revenue by renting equipment typically. So again, if the court were to find that you can't do trending, it would have to be kicked back to the department, and the department might look and do some kind of a market sales comparison approach or a blended version of the 2 or whatever it might be. And but that, again, going back to the error correction statute, that's not properly an error correction. That is heavily discretionary, and so it's simply can't be the subject of an error correction claim. And just finishing up on the point I was making, the relief sought by Penn in this case, the straight line depreciation, is just objectively not correct. Not only is the error not correct, but the correction that they're seeking, the relief they're seeking, is completely incorrect. If they had cited one authority about straight line depreciation being an appropriate depreciation method, I would have liked to have seen it, but they didn't. They just clearly want a windfall that they aren't entitled to. And I think I will defer the remaining time to my colleague.
Good morning. Kathleen Patterson from Maricopa County Attorney's Office on behalf of Appellee Maricopa County. The county, through the assessor's office, is the assessing entity or government entity that valued Penn's property. In this case, we used ARS 42-13-352. You've heard all the time so far talking about subsection C. It's the county's position you can't really interpret C unless you read the whole statute as a whole. The assessor looked at the A, B, and C, and in applying it, A starts with the county assessor shall determine the value under the statute. The B section says, for purposes of determining the value of property that is valued under this article, the county assessor shall use standard appraisal methods and techniques. All that the department has been talking about at this hearing and in our briefing is about using standard appraisal methods and techniques, which determines market value rather than technically a statutory value. We know, for example, the residential common area, the statute says it's valued at $500 a parcel. That's statutory. Absolute, no discretion, no analysis whatsoever. But here we have the command to the assessor to use standard appraisal methods and techniques. And then it goes on, as provided in 42-11-001. It even incorporates the very definitional statute in which market value determined by standard appraisal methods and techniques defines that as market value. So that is a reference, incorporating by reference, again, the standard appraisal methodology. And then it goes on and adds 42-11-054, which is the third statute and the third time that this valuation statute incorporates standard appraisal methods and techniques by reference. So we have 3 times up to this point in this statute where the assessor is being told standard appraisal methods, standard appraisal methods, standard appraisal methods. Then we get to the exception. As Penn would have it, the exception swallows up all of what I just said, and it doesn't apply. We disagree. Subsection C then, that talks specifically about the taxable value of personal property, is referring to some standard appraisal method. It must, if B has any meaning at all. There are 3 approaches: sales, income, and cost. And as you heard the department explain, there are some personal property that is valued by some of those other approaches. The assessor interpreted C to mean there's one of those that apply if it's to be standard and determining market, and the one that applies that uses acquisition cost and depreciation is the cost approach. And so from the assessor's point of view, all of this conversation is all about what is the market value on the date of valuation, and that's an interpretation of this statute and the terms that I just went through. So when we applied the statute, we're looking for market value. So in getting to the dispute here about whether C means should be acquisition cost or should be this or should be that, it has to be in the context of we're looking for market value. We're not looking for some just technical word of acquisition. It's a methodology. And the reason part of the reason that the court ruled in our favor, I believe at the trial court, that is because the idea that appropriate depreciation is discretionary is part of that methodology. It's a whole. It's a unified whole. We're not just subtracting one element out of it, the trending factor, isolating that and pretending that it's not part of a whole market methodology. So the county, of course, contends there is no error on the part of the assessor. The assessor interpreted a statute. The statute is there. The words are clear on their face. There is no, it's clear allegation to me still what the error is or which section of the error statute that the plaintiff is actually relying on, but the actions of the assessor in following the statute and applying market methodology that is prescribed by the department manual is mandatory. The assessor didn't err at all. There was and other aspects in our briefing about why we believe there is no error claim. One of them was touched upon earlier, so, we're done.
But your
It's in my
point is,
brief.
your point is that to understand what is intended by C, you have to interpret that in light of the directive in B, that the county assessor shall use standard appraisal methods and techniques.
Absolutely.
Mr. Patterson. I'm sorry, Mr. Garrett.
Thank you, Your Honors. First of all, there's a red herring of, oh, gee, they haven't showed anywhere that straight line is applicable. Under the authorities that they cite, straight line is not applicable even when they use it. They use straight line. They're not allowed to. They're saying that we can't, but then they don't anyway. So they use the straight line. It's not consistent with how it works. They're saying that you can't use straight line without trending. Well, the authorities say you can't use straight line even if there is trending. So that doesn't make sense. They state that acquisition cost is just a starting point. Well, if it's just a starting point, then what? You do anything you want after that starting point? No. What they're saying is that acquisition costs less appropriate depreciation, and they're putting trending in depreciation. That's what they're doing. And they're saying that if you put trending in depreciation, somehow it turns into a standard appraisal technique. Well, we're not after standard appraisal techniques here. We're after following the statute. And the statute says when it provides what you're supposed to do, you do it. Otherwise, in 11,001(6), you do what the statute says if it provides a method, which it does, clearly. And you can't just open this up to anything you want. They say that the ultimate goal is fair market value. They're wrong. The ultimate goal is a value as prescribed by statute. If it's prescribed by statute directly or prescribed by statute as a approximation through fair market value. Thank you very much.
Thank you, counsel. Appreciate the arguments here this morning. We're going to take this matter under advisement, and we will prepare a written decision, and you'll have that in due course. With that, we stand adjourned.